Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I am your host, Dr. Daniel Crosby, and I am joined today by James Fletcher, founder of Ethos Investment Management, a focused ESG fund that will be launching probably about the time this podcast drops in early 2022. Prior to founding Ethos, James managed $1 billion emerging markets portfolio for APG, the largest pension fund in the Netherlands. He's here today. We're going to talk about ESG. We're going to talk about the opportunity set in emerging markets and international stocks. We're going to talk about the benefits of travel and spending time abroad. And we may argue about the best burrito in Utah. James, welcome to the show.
Daniel, it's such an honor. And long-time listener, first-time caller. I think I was a early listener of, what was it called? The Laws of Wealth, when you were doing your original podcast?
I changed it like 3 or 4 times, which is like just terrible business, right? I mean, it's like I changed it. I kept changing it. And then I think I named it something without checking, and someone else had a podcast by the same name. So we've landed on Standard Deviations, but you've been there since the beginning, and I appreciate it.
I love it. Such an honor to be on.
Yes, sir. So the first question, we're, look, I'm glad you're a fan. I'm glad you're a listener, but that doesn't mean I'm going to go easy on you. The first question is effectively, are you crazy, right? This is a time when fund flows are going passive at a 3-to-1 clip.
Yes.
We've got the largest 3 asset managers in the world gobbling up an increasingly large slice of the pie every year. Are you crazy to start a boutique-focused fund in this environment? And what's the secret to coming out of the gate with like $100 million in AUM? Because you've really gotten off to a roaring start here. You are not even launched yet, and you're doing great already.
Yeah. I mean, I'm thrilled and blessed and excited to be launching a fund right now. Like you said, we've certainly seen headwinds in active management for the past 5 to 10 years. But at the same time, we've also seen just a flood and very strong returns into private equity venture capital asset class, which I would say is the epitome of active management, concentrated investing. So on one hand, I think there's been for good reason flows away from closet index funds that are charging active manager fees but own the index more or less, and investors are just more savvy that this is you're charged a high fee for basically index returns. At the same time, I think the industry is more aware that a highly concentrated approach, knowing businesses sort of inside and out, and we would argue that emerging markets is really some of the most inefficient active classes in the world. So when you're taking an active managed approach, what you need is inefficient market class. And I focus on emerging markets, which is China, India, Brazil, Russia, Taiwan, Southeast Asia. And even more so for the past 12 years, I've really focused on emerging market small cap. And here, this is one of the most last frontiers of inefficient market class, family-run businesses, some wonderful businesses, but inefficient. So on average, the companies in our portfolio are only covered by 0 to 2 analysts. Very, we're getting our companies at 40% discounts to what they would be priced in developed markets. And we can talk about it more, but we believe in emerging markets long run. These are the growth engines of the next 10 to 20 years of China, India, Brazil, but with a lot of risks in the market. So we would argue that an actively managed approach has is crucial. And, part of the success of launching Ethos right now, and we have some, like you said, we have $100 million and counting of some incredible seed investors. And I think they're looking for exposure to emerging markets. They're also looking for ESG integration and sustainability in their portfolio. And we have sort of long-term returns to demonstrate that we've consistently been able to generate, solid returns and outperform the market. So, I think your point is a good one of we've seen this rising tide toward passive, but at the same time, I think the rising flows to PE, VC, and highly concentrated active funds like mine that have been able to significantly outperform the market. I think there's still, a strong case for them, especially in emerging markets.
Yeah. So we're going to talk about every piece of that. I'll begin with, any good active investor is going to have given some thought to their edge. Now, in a world, right, like in a world where the big boys and girls have these extremely well-funded research shops, AI, every other sort of advantage, you're running a very small 3-person shop out of Salt Lake City and Park City. Yes. What edge does a small boutique asset manager like you have in a world where you have such well-resourced competitors?
Yeah, so a couple of things. And, in some of these you highlight in your book and in your work as well. One is just a long-term investment philosophy. So we truly are long-term investors. The turnover in my portfolios, over the past 17 years has been about 20%, which means that the time horizon is truly 5+ years. And we've owned some businesses for 10+ years. All investors talk about a long-term time horizon, but then you go look at the numbers and the turnover is 120% and they own, 200 companies in the mutual fund. And so essentially, your time horizon is only 9 to 12 months. So we can truly take a long-term investment horizon, and we've attracted the right clients for that. The other thing is we're not trying to do everything for everyone. We're concentrated on a select number of sectors and business models that we have discovered to be long-term compounders with what Warren Buffett calls wide moats and high returns on capital. So the portfolio being 30 to 40 stocks, and these are companies that we've known for decades. We've built up over, my 17-year career, a focus list, which is taking a private equity type approach to the public equity markets and doing months and months of due diligence, background checks, industry analysis, building financial models, engaging with management teams, where, now I have sort of 300 companies, which we have, through our vetting process, seen as the top 5 percentile of quality businesses, excellent management teams, low regulatory risk. So I can just give you an example, maybe would be helpful. So Nice Information Services is a company in Korea that we invested in a couple of years ago. Nice Information Services, for your listeners, is they're the Experian or the TransUnion of Korea. So they provide the credit score for the majority of Korean customers. So they have 75% market share. High barriers to entry. We know this business model from developed markets. It's a long-term compounder as you monetize that credit information, and very high barriers to entry, both regulatory and brand moats. We went into Nice Info. We were actually looking for this type of business throughout emerging markets, China, India, South Africa. We stumbled upon Nice Info in Korea. At the time, they had no broker coverage, no institutional ownership. It was a $350 million family-run business that was completely under the radar screen. And we went and met with them, which translated a broker in Korean with us. And what we found is a great business, growing double digits, 30% return on invested capital, very high barriers to entry, and that was very immature and very undiscovered. And so we basically, did our 2 to 3 months of due diligence, background checks, talked to competitors, talked to customers, talked to management multiple times. And by the end of that, we invested. We bought 5% of the shares outstanding. And then we started to engage with the company. So and we'll talk about ESG more, but we do an ESG Score Card, which is it's 20 to 30 hours worth of work. We have 50 points that we go through, everything from governance to company mission to company culture or ethos. That's why we call it Ethos Investment Management. History of capital returns. We presented it to Nice Info, and we presented to all the companies that we invest in. And basically the pitch is, we're not a hedge fund. We're not going to short your stock the next quarter. We're long-term investors and partners with you. And every investor in the world is going to be asking about, these ESG criteria. And in Nice Info's case, the disclosure was poor. They needed to publish in English. Independent board structure was low. We suggested putting 2 independent board members on their board. Dividend payout was low. It was only 15% payout ratio. We recommended increasing that at least to 25%. Succession planning and some KPIs were weak. And basically at the end of that, the company started taking some of our advice. And actually what happened in Nice Info's case then is later that year, the chairman passed away. The son, Mr. Kim, was more amenable to our engagement targets and basically started publishing in English. We helped them get to investor conferences. They put 2 independent board members on the board. They raised their dividend policy. And we bought Nice Info at 13 times price to earnings ratio when their global peers were trading at 30 times PE. And now Nice Info has tripled. The stock is re-rated to 25 times. And we still see immense sort of long-term compounding potential in the business. So, that gives you an idea. It's much different than your typical mutual fund. It's more like a private equity type approach. And we've built these relationships now over 17 years with, our 300 companies in the focus list. So to your point, with our small team, we're able to do the amount of research that we do and really take a concentrated approach that very few other investors are taking this type of approach, especially in emerging markets where we see sort of a lot of low-hanging fruit like Nice Info to benefit from re-rating great businesses.
Now, it's interesting. I think we're all familiar with activist investors, but this is almost like a form of ESG activism where you're suggesting sort of governance and social and environmental, perhaps, changes that can be made. How are those typically met by the companies you invest in?
Yeah, so you see, as you would imagine, you see the full spectrum in emerging markets. You see, when we're going to Chinese companies or Korean companies or Indian companies, there are some, management teams and founder-run families that basically say, take a hike. We're not interested. We run it and you don't understand our market. But what we try and do is we try and provide them the averages within their country, some examples of best practices. And then we tell them stories like Nice Info. It's not, we don't call ourselves activists, but it's engaged shareholders. And not being a hedge fund, not sort of that risk of them us shorting the stock, and knowing me over sort of my long-term career that I'm a partner, I'm a long-term investor, has honestly, Daniel, it's allowed me to get indoors that I've never been able to get in before. A company in Brazil called MGS Bronco. I met Mr. Evans Bronco, which is the family owner. I think I'm the only institutional non-Brazilian to meet him. Rarely meets investors. But because we had our ESG scorecard and we came to them with, we have where you're ranking strong and where you're ranking weak, and we're long-term partners where we believe in your company. We love your brands. They're the largest cookies and crackers business in Brazil. They basically said, yeah, fly to Fortaleza. I did a meeting with Mr. Evans Bronco and had an amazing sort of half a day with him. And we talked about some strategy and we talked about some things that they can improve on. And, it's actually opened doors. On the flip side, you learn a lot about a culture and the family through this engagement process. So you also learn, we invested in a company in Korea. I won't give their name, but they're a large home improvement retailer like an IKEA. And we started engaging with them, and basically they were angry, offended. We talked to their CFO, and their CFO was like, sorry, James, like, it's our CEO's, it's his way or the highway, and he really doesn't listen to anyone, even at the company. And after that, we sold the stock. And 6 months later, they had a sexual harassment lawsuit. They didn't fire the employee, got a lot of really bad publicity. And then a year later, they spent $1 billion and bought an office building in downtown Seoul, which was a terrible use of capital. And the stock was down 50% a year later. So you learn a lot about a business and a management team through that engagement process.
Yeah, there's some information to be had in that ESG back and forth. It sounds like as well some valuable investing information. So you run a focused 30 to 50 name SMID cap emerging markets fund. I've written in both of my most recent books about the importance of either being truly active or truly passive.
Yeah.
I see immense benefits, right? I see immense benefits to passive investing. Broad exposure, low fees. It's a great way to go. But where I get upset, and I do think it's sort of the industry's dirty little secret, is research done by Alpha Architect shows that about 3/4 of funds that are nominally active do not differ meaningfully from their benchmarks at all. So effectively, you're paying active fees for index-like management. And that to me is this dirty little secret of the business. That's where you don't want to be. So talk to me about this decision to run a high conviction fund. How do you think about conviction and diversification, and what led you to take this sort of unusually concentrated approach?
Yeah, and to be fair, I would say stumbled into it, and I've always invested with this concentrated approach. So I was hired out of school. I was a Mormon missionary in Brazil. I was hired as a Latin American analyst at a fund in Boston that took a highly concentrated long-term approach, and they were highly successful. I mean, really, even before that, it was, I read Buffett when I was 15 years old, and it literally changed my life. Like, it just made so much sense, and I just loved the long-term philosophy. And Buffett has his famous quote about a punch card, which is basically, imagine investing is like a punch card where you get 20 punches over your career and make those punches count. And when you invest, make it be high conviction. And so I've always believed in that. I believe as an investor, it takes a tremendous amount of work. To your point, most investors should probably be passive, because the amount of work that we do, 4 to 6 months of research before investing in a business, and background checks and channel checks and talking to competitors. And we talk to over a dozen employees before we invest, and we read Glassdoor ratings, and that type of investing is not sort of casual and okay, I like this theme and I'm just going to invest in a couple stocks here and see how it goes. I think that's where a lot of investors get into trouble. And so for us, it is concentrated, it's high conviction, and I sincerely believe that your 10th best idea is better than your 200th best idea. And when you invest in a concentrated manner, like we've talked about, you get to know the people really well. So these relationships that I have with the businesses in our portfolio and the ones in our watch list, these are long-term relationships where you get to know the management, you get to partner with them. And in the end, investing is about people, right? So it's people executing on a business plan, it's people making capital allocation decisions, and getting to know the people and the families that run these businesses, I think, is crucial. And so that concentrated approach has served us very well. We've significantly outperformed the market, and I think it's because we have conviction, we invest with long term, and we invest with really exceptional people running the businesses.
Yeah, I would tell the listeners, just, get the essence of whatever your style is, right? If you want to be a passive investor, and I think I agree with you, that's the right answer for most folks. Yeah. Go get something that is enormously diversified and exceptionally cheap, right? Yeah. And if you want to be an active investor, look for someone who's doing the appropriate amount of diligence, investing in a way that's consistent with your beliefs, and really taking a bet, right? Really taking bets, really, has high conviction, never get caught in the middle. All right, James. Well, we can't talk to the founder of Ethos without talking about ESG. Now, ESG is having a really big moment in the sun. Fund flows have been excellent. And in some respects, it feels like ESG, which has been talked about forever, is finally coming into its own. But I read this article yesterday. LinkedIn had this 22 trends for 2022. And one of the trends that was fascinating to me was something to the effect of, the ESG emperor will be exposed as having no clothes, citing this BlackRock whistleblower and other similar cases where, yes. Former ESG execs have said, look, there's really not much here. So why do you think ESG screening is important, and how sort of specifically do you incorporate it into your process?
Yeah, so that's a great question. We see a lot of greenwashing. I think it's exciting on one hand that ESG is having its moment in the sun and we're seeing flows into ESG. But on the other hand, I think there's a lot of disingenuous or even difficulty in defining what is ESG in the industry. And I think, honestly, that's the opportunity for us as long-term investors. So just as a background, as we've talked about, I've always been an investor focused on quality businesses, focused on great long-term returns in sustainable businesses. But when I joined APG, which is the largest pension fund of the Netherlands, Europe was very early on ESG, and Netherlands was the earliest and biggest in that group. Honestly, I thought ESG was going to be more of a distraction. So, we had to provide monthly and quarterly data points, and ESG was integrated into the process. And, we had done what we had done, which is always deep due diligence on governance of companies. But what we did at especially our Asia team and my team, is we took all of that data that we were getting of diversity and compensation and carbon footprint and board structure, and we built it into how a fundamental investor would look at it from the bottom up in terms of materiality and in terms of the factors. So then we built an ESG scorecard. And then we engaged with companies to help them improve key factors that would drive materiality. To be honest, today, ESG is still in the very early days, and there's lots of problems with sort of the face value of ESG reports. So, Tesla may be rated by one rating agency because it's electric vehicles, and F-rated by another because it, has supply of lithium ion and mines and poor governance with Elon Musk. And so, the ratings are highly subjective. Currently, a lot of the ratings are based on disclosures, and it's more sort of a box checking rather than a true understanding of the country, the sector, the family, how the business is run. So we're still in very early days, and I think that's why you hear a lot of complaints about ESG at the same time, that it's sort of not defined well, disingenuous, greenwashing. And frankly, I would agree with all of this. What we're trying to do at Ethos Investment Management is really build a boutique focused on long-term investing, but also as responsible investors and aware of the impact of our investment decisions, and built as you would build it from the ground up. So with a robust ESG scorecard, engagement as long-term partners of the business, and through that process, generating returns. So the big question in ESG and sustainability right now is, okay, I know I need sustainability in my portfolio. I know I need a lower carbon footprint. I know I need ESG, but how much do I have to sacrifice returns to have a more sustainable portfolio? Our argument is, especially in inefficient markets like emerging markets, is you can actually augment returns through that engagement process, through helping companies re-rate through better disclosure, better treatment of employees, better governance practices, being on the right side of long-term environmental trends. Will actually help add value to the business. And that's the discussion that we're taking to companies, is that we're partnering with you to increase the long-term value of your business. And that's good business for us as shareholders. It's good business for owners, but it's good for society as well. So we really think that we can all benefit from this, trend toward good businesses that do good for society, that treat employees well.
So in many respects, your approach to ESG mirrors your approach to investing. It's
Yes.
Labor intensive, bottom up, fundamental.
Exactly.
It occurs to me, friend of the show and former guest Perth Toll has a freedom weighted ETF, and it occurs to me that you're investing in some countries where human freedoms and human rights are limited, often curtailed by the government. Here we are at a moment where there's talk of China invading Taiwan. There's talk of Putin's amassing large troops on the border with Ukraine. How do you think about ESG and investing in countries where the bar for ESG may be very low, and does that make you shy away from those countries, or does it create opportunities and inefficiencies?
Yeah, so great question. So we're only looking for the best 30 to 40 to 50 businesses in emerging markets, which means I only have to find 6 remarkable businesses in China, and 6 remarkable businesses in India. And so even though there may be a lot of state-run businesses, there may be a lot of regulatory risk and tough governance practices, our highly selective approach, and knowing these markets and having invested for 17 years allows us to sort of filter what we think are the top 5 percentile of businesses, management teams, and regulatory risk. So in China, for example, we've continued to deliver good returns because we've avoided a lot of the highly regulated sectors. So we had no exposure in after school education. We had no exposure in live stream video. We were very wary of anything Jack Ma linked over the past 2 years. And so part of this is our ESG scorecards and our channel checks, and the more sort of we're digging around in those industries, the more it was apparent that there was regulatory headwinds and there was risks on the horizon. Russia, for example, we only own one company in Russia. It's a company called headhunter.com, and they're the largest online job portal in Russia. So fantastic network effect business, growing double digits. It's a business model that we really like and they only price about $400 per job posting compared to global peers of online job portals, which are $3,000 to $4,000 per job posting. So immense pricing power. But then the key is that the management team is excellent, extremely well regarded, very focused on shareholder wealth, but also sort of good for society, in that the government and Putin wants low cost, low friction hiring to hire more, Russian citizens. So we make sure that our investments are all on the right side of regulatory trends, government trends. And, Russia is a country that is notoriously very difficult to invest. But when we find, a handful of businesses like headhunter.com, these are the businesses that can still be great long-term businesses to own and are immune to a lot of the regulatory risk.
Staying on the emerging markets theme, we're here in early December, so I won't get too granular with my numbers here, but the price to sales ratio of the S&P is now over 3, right? Yes. So it was about 2.25 during the tech bubble. It is truly for sort of a value-oriented, value-minded guy like myself. I know you view the world through the same lens. It's pretty incredible to look at some of the valuations in the U.S. And yet I've been skittish about valuations in the U.S. for many years now, and being skittish has been the wrong move, right? The U.S. has been on an absolute tear for a very long time. And you look around the world, I think, especially in emerging markets, and on paper, the valuations look much better. But then you've got all these government risks and regulatory risks and, COVID and all a host of other problems that are keeping these valuations down. Why are you bullish about emerging markets, and what makes you think that emerging markets, which have been priced attractively relative to the US for many years now and have underperformed, are poised to do well in the future?
Yeah, so great question. So, another valuation metric is price to earnings ratio. S&P 500 as of December is at 25 times price to earnings ratio, compared to emerging markets, which is at 14 times price to earnings ratio. So that you're over a 40% discount. And we're seeing that on a like for like basis across sectors and high quality businesses that we can pick up at, 40, 50% discount to their developed market peers. To your point though, and so even though these are near 20-year historical valuation gaps, to your point, EM has been cheap for the past, 5 years or so, especially. What I was actually looking at data a couple days ago. If you zoom out a bit more, so if you look at 20-year returns from 2001 to 2021 in November, I think most of the listeners would be surprised that EM and developed markets have delivered almost exactly the same returns. So EM's delivered 9.7% annualized returns in US dollars, and S&P 500 has delivered 9.2% in US dollars. And so, I think it's just good to remember that things go in cycles, and that over the cycle, returns tend to be very similar. And what I would argue is that, we're at a period in the cycle where it's indicating that, returns are likely to be attractive in emerging markets given that valuation discount. In terms of, big picture, what we have in EM is a rising middle class. We have a lot of development into consumer sector, IT sector, healthcare sector. I like emerging markets because in some ways it's easier to predict than developed markets, because you're 5 to 10 years behind trend in developed markets. And so you can see what businesses succeed. You can find, the Amazons or the Googles or the specialty chemicals in developed markets, and then copy and paste and find those businesses in emerging markets that may be 5 or 10 years behind. So in some ways, EM investing is easier because you have the playbook. And what I've seen over my career is if you get the business model right, you can be very successful in investing. So even if the macro is, blowing up like Argentina, if you own Mercado Libre, which is the largest e-commerce platform in Argentina and Brazil, even though the macro is terrible over the past 10 years, if you get the business model right, these are powerful long-term compounders. And then I'd say the other thing is, I've done EM investing for 17 years now. And in some ways, I'd say this is the most exciting time in emerging markets, because a lot of these markets haven't had access to capital in a meaningful way throughout their country's history. And now, and it's evidenced by the IPO market. Now, IPOs have never been higher in India, in Brazil, in Southeast Asia, in China. And the reason is that there's local VC funds and private equity funds that have access to capital, are investing in innovative businesses. You're seeing that trickle down effect. More unicorns have been created in China over the past 10 years than have been created in the US. So I think is shocking to investors. When you look at top 100 brands in the world, China is by far growing those most valuable brands. So, but at the same time, you need to be very wary of, old economy businesses and cyclical businesses. EM in the past has had a lot of exposure to commodities, but now you see growth in, structural growth businesses of healthcare and IT and tech. And those businesses have continued to perform very well. So part of it is when we look at the face value of EM, it looks boring. It looks like low earnings growth. But what you're seeing below the surface is a lot of growth and innovation in sort of new economy businesses and the decline in sort of the old commoditative businesses and state-run businesses and large banks. So I'm to be honest, I'm as excited as I've ever been with emerging markets, because you can go to these markets and feel innovation, access to capital, new companies are going public, new innovation in sectors like healthcare and internet and software that we've really never seen before. So yeah, and I think over the next 10 to 20 years, these are going to be the growth markets of the future: India, China, Latin America, Southeast Asia.
I think that's one of the big ideas I'll take from our time together. I think when I think about EM investing, I think of it as, sort of inherently chaotic and unpredictable, owing to some of the, sort of some of the structural weaknesses and the developing nature of some of these countries. But I love what you said about, in some ways, you've seen the future, in the sense that you're 5 to 10 years behind. You've seen the future, what's next, and it could actually be more predictable. So with sort of my closing question here, I want to focus on some of your philanthropic and charitable work. You're the founder of the Young Investors Society. Can you tell us just a bit about that organization and why you think it's so important?
Yeah. So, as you can probably tell today, I'm passionate about investing. I read Warren Buffett when I was in high school, and I love teaching and mentoring, and I just believe in long-term investing. Actually, tell you the story of how it started is interesting. So I was in Los Angeles. I was volunteering at SIFMA's, the stock market game, and they have a program called Invest It Forward, where financial professionals go into schools and speak to the students. So I was going in speaking to the students, and for the listeners that aren't aware, the stock market game is about 1 million kids a year, either junior or senior year in high school, do the stock market game. But what you're trying to do is outperform the market and your classmates over a 3-month period. And every time I would go into the classes, as you can imagine, I would say, "What's in your portfolio?" And they'd say, "Loss-making biotech companies and triple leverage ETFs." And basically they're taking as much risk and as much beta as they possibly can. And, I'd have to say, whoa, guys, this isn't investing. Investing is, what company do you want to be the owner of 10 years from now, and why? And let's talk about, what can make that a great business. And so I visited a school in inner city Los Angeles, Roy Ball Academy, and had just an amazing discussion and told the kids that, I invest in Latin America. I invested in a lot of companies in Mexico. I was looking for people that understand, that culture and that language. And I got a number of letters from the kids. And one of the letters I got was from a young man named Edgar. And he wrote me and he said, "Mr. Fletcher, your visit has meant so much to me, said, no adult has ever visited my class before or showed that they cared. And after that 45 minutes, I now have a vision of what I want to do. And I now want to go to college. And, that letter of his words saying, no adult has ever shown that they cared before, just resonated. And it just wouldn't leave my head. And I went to someone from Harvard Business School. I went to someone from Merrill Lynch that was retiring in Fidelity. And I said, let's create an organization that teaches investing the right way, teaches long-term fundamentals, teaches personal finance. And basically, we modeled it after the CFA Institute. We do a stock pitch competition similar to the CFA Institute's stock research competition at the university level, but we focus a lot on personal finance and on budgeting. And we, had the challenge of teaching stock market fundamentals to teenagers and making it engaging and fun and cool. And we think we have 60 modules now that the kids go through. And we hit on a nerve, basically, that it has grown from 6 schools 6 years ago. And then it's continued to grow. And through COVID, it's grown even more. And now we're in 1,200 schools in 24 countries around the world. So it's over 10,000 kids a year. And CFA Institute has adopted it as their high school organization. We've had some amazing backers from banks, and then we do a Access initiative, which really focuses on underprivileged communities and helping them, especially with personal finance of bank accounts and budgeting. And I've just been so blessed and blown away by knowing the kids and seeing their excitement and seeing the next generation of not just investors, but entrepreneurs and accountants. And through that lens of investing, you can teach kids so many skills that they'll use in the future. So it's just been, it's just been one of my callings, and it's just been so fulfilling to see the kids rise to the occasion and to see them really grab hold on something that's fun, but also very useful. And honestly, I don't know how we don't teach personal finance at the school level. I don't know how we're not requiring every teenager to read Daniel Crosby's The Law of Wealth, because these are skills that all kids, all teenagers should know and should learn.
Well, what an incredible legacy and what incredible reach. My daughter is in middle school now, but a few years ago, her teacher called me into her 5th grade class, and they were doing some version of this stock market game. And it was like they had 3 weeks, and it was, who could generate the highest return portfolio in 3 weeks. And I had to come in and talk to them and sort of be like, this is all wrong. Like the whole premise is crazy, and no one should invest this way. So I'm glad to see that thoughtful people like you are bringing real educational insights to our kids. So James, if people want to learn more about Ethos, if they want to learn more about the Young Investors Society, where can we find out more about your work?
Yeah, absolutely. So I'm active on LinkedIn. Feel free to reach out. The website for Ethos Investments is ethosinvest.com.
Huge thank you to James for joining me this week. I hope you enjoyed our conversation. If you did, I hope you'll take the time to check out James' work through Ethos or the Young Investors Society. Stay tuned next week when we bring you another exciting guest and an interview with an industry expert. Thanks so much, and we'll see you then.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.